All right, it's official. Jerome Powell does not like us. Jerome Powell wants to see maximum pain in the economy. Stay tuned. I'm going to tell you how this is going to affect mortgage interest rates now and into the future. All right, that intro might have been a little bit dramatic, but Jerome Powell today, speaking in front of Congress, had some hawkish comments that rumbled markets. And for our purposes here on the Matt the Mortgage Guy channel, I'm going to tell you how they affected the mortgage markets, more specifically mortgage interest rates. So before I show you the charts where mortgage rates are currently at, I'm going to tell you about his first day of testimony, which I just got done looking at kind of some reviews and how that's affected the market, right? So as of today, Tuesday, March 7th, Jerome Powell has had his first day of testimony before Congress. Super, super hawkish comments, which means the odds of more Fed interest rate hikes and bigger Fed interest rate hikes are much more likely. It was literally like a month or two ago where we thought we might have been done. We thought we were in a position where the Fed might start to talk about a U-turn, and truth be told, they kind of did. Today, not so much, right? So in his initial statement, Jerome Powell talked about the difficulty of getting stubborn inflation back down to the Fed's 2% target, which has always been their target, and basically said that there's more work to do and higher rates to come. A higher for longer approach, which he's talked about a little bit in the past, will likely be necessary. These are all comments that hurt mortgage interest rates, right? When mortgage-backed securities hear this news, they start looking like red candles, right? I'll show you what that actual chart looks like later on in the video. But like a higher for longer approach, in his view, and honestly, it's going to slow down the economy, weigh on the job market. That's what it's going to take to pull down inflation, at least according to him and his colleagues. So little sign of disinflation thus far in the category of core services, excluding housing, which accounts for more than half of core consumer expenditures. I want to take just a little bit of time to talk about this, and without going into super detail, housing expense, whether it's rent or whether it's mortgage, makes up a good portion of this part of inflation reading. And the problem is, other people can probably explain this a lot better than I can. This housing data lags. Within the inflation numbers, it shows housing costs increasing. But when you look at it on a month-to-month number, according to almost any metric or anywhere you're looking, housing expenses are coming down. Median cost of a home coming down month on month. Rents in most areas coming down month on month. Yet in our inflation reading, that housing expense is a positive number, pushing inflation up. So we've got to wait. And I heard somebody explain it pretty well about how, you're not going to see the true rent numbers because of 12 months leases and things like that until a year later. So the roller coaster analogy, Barry Habib and others use it, where the front of the roller coaster is already headed down, and that's where it is month on month, but that the readings are back here showing it on the uptick, right? And so it's a lag effect, right? So Powell goes on, right? To restore price stability, we'll need to see lower inflation in this sector, and there will very likely be some softening in labor market conditions, meaning we're going to do what we got to do. We're going to increase the cost to borrow. It's going to hurt the economy. It's going to hurt the labor market, but oh well, it's what we got to do to curb inflation. The latest economic data come in stronger than expected. Again, we don't have to harp on the 517,000 jobs. When you look at the true numbers, like the Bureau of Labor Statistics shows a net loss of 2.5 million jobs. But here's what they did. They said, no, no, no. January, you got to look at the seasonality. People work seasonal jobs and get laid off. So in a normal market, we see 3 million jobs lost. We only had 2.5 million jobs lost. So that's really an increase of 500,000. That's literally how that job number works. And so 517,000 jobs, economy's doing fine. Crank up the volume, crank up the rate hikes. This is real, true stories. 4 strategists kind of weighed in on Jerome Powell's comments today. I'll go through those really, really quickly. You know, the first senior investment strategist that talked about it said, unsurprisingly, Chairman Powell delivered a message with hawkish undertones in his testimony to Congress. While acknowledging the recent string of economic data has been stronger than expected, he reiterated the ongoing increases in policy rates are warranted, right? So that's just a recap, right? And he talks about some market participants might have been caught off guard, but the reality is he's largely affirming what the bond market has already priced in. So on to the next analyst, Callie Cox from eToro. Powell just said the quiet part out loud. The economy is performing impressively well, but that could complicate the Fed's efforts to bring inflation down. Therefore, the Fed could accelerate rate hikes and hike more than expected to bring inflation down. This is the part where, you know, the markets threw a little bit of a tizzy today because on this news, they can now reasonably expect, are we going to get a 50 basis point hike? Are we going to have 4 more hikes, 6 more hikes? What's coming? High inflation can warp our thoughts around money and drive a wedge through society, worsening trends like income inequality. Powell has made it clear the Fed is willing to sacrifice growth and job market strength to ensure this doesn't happen. All right, then we got John Lynch, CIO for Comerica. The bear market rally that began in October has been supported by hope over reality. Fed Chair Powell's comments today should come as no surprise to investors. Employment and consumption have been strong, while the easy gains in the battle against inflation have been made. Higher for longer should be taken seriously by the markets. We continue to position portfolios for quality in fixed income and value and profitable small caps, yada, 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 yada. All right. Jeff Roach from LPL Financial. Rates will likely be higher than expected, but inflation is still the wild card as the Fed remains data dependent. This one I think is important to think about because when the data changes, the Fed changes their stance, their tone, their talk, and ultimately what they do, right? The Fed will have several key metrics in hand before their next meeting, including another look at retail sales and inflation. So before their next meeting, we got another inflation reading for February that's going to come out. Granted, inflation will likely stay elevated in the near term as consumers release pent-up demand for services, but rental prices, a key component for inflation, are set to decline as additional multifamily units come online in the coming months. They've already declined. It's just a matter of the data catching up. All right. So let me show you real quickly. Today is this red candle, and 30 basis points in mortgage terms, roughly about an eighth in rate. So it's not a huge deal. This 7.03 will no doubt come out a little bit higher tomorrow on March 8th when these numbers get released. But remember, this is a national average. Remember, this is for great credit. And so don't be surprised if you're buying an investment condo if you've got a rate, that's 8%. If you're putting 3% down and you've got a 655 credit score, your rate could be even higher than this. It's a challenge. I get it for affordability, but according to Jay Powell, like this is February 2nd right here, and it's been, as these go down, that's mortgage rates going up, right? This is mortgage-backed securities trading here, and then you've got, since the last month, it's been a pretty steep climb from February 2nd, sub 6%, to over 7% now that we're into the first week of March. So stay tuned. You're going to be watching inflation numbers, other key economic data that the Fed looks at to see what their moves are, and ultimately what that does to mortgage interest rates. So found this helpful. Leave a comment, like, subscribe, do all the things. I appreciate you. I got 800-ish videos on YouTube. So if you've got mortgage questions, I might already have them answered. Go to the search bar and type in Matt the Mortgage Guy, how do escrow accounts work? Matt the Mortgage Guy, should I pay points? And these things, and you'll find my videos there. If there's something you want to see that I haven't recorded yet, send me a message. I'm happy to help.